Okay, dear students, let's start the third live revision class of FR, March 2025. We are let's start with from question number 11. What will be the depreciation charge? What will be the depreciation charge in V-Ton's statement of profit and loss for the year ended 31st March X5? So we are required to calculate depreciation expense for the year ended March X5. Okay. The following trial balance extracted relates to the property which is owned by Wheaton as at 1st April X4. Property cost is 12,000. We are ignoring 3 zeros and original life is 20 years. There is already an accumulated depreciation at 1st April X4 3,600. On 1st October X4, the following sustained increase in the property prices. Wheaton revalued the property 10.8 million. Now listen carefully. We have been asked to just calculate depreciation expense, number one. And we have to work on these values because in the answer, examiner has already ignored the 3 zeros. Another point is, the year end is March X5 and mid of the year, 1st October X4, mid of the year, organization has already revalued the asset. It means that first 6 months, we will depreciate the previous cost of the property over its original life, which is 20 years. And after evaluation, we always depreciate the asset over the remaining life. So first 6 months, the depreciation will be on its original cost and over original useful life, which is 20 years. After evaluation, we will be depreciating the revalued amount over the remaining life. So let's calculate depreciation expense for the first 6 months. 12,000 divided by 20. 6 upon 12. Just a minute. 12,000 divided by 20. I'm getting 600. Then 6 by 12 means 300. So first 6 months, the depreciation is 300. Now we need to calculate depreciation expense for the remaining or last, or you can say the next 6 months after evaluation. After evaluation, the revalued amount is 10,800. We have to divide this with the remaining useful life into 6 upon 12. So actually, for depreciating the revalued amount 10,800, we need to have the remaining useful life. How to calculate the remaining useful life? It's very simple. 12,000 original cost divided by 20, we are getting a depreciation of 600. So 600 is the depreciation per year. 600 is the depreciation per year. There's already accumulated provision for depreciation, which is 3,600, which means that 3,600 divided by 600 gives us 6. So at the start of the current year, 6 years already they have passed. We have revalued the property exactly mid of the year in the current year. It means that original life is 20 years. Out of 20, 6 years passed till April X4. Then the property was revalued on 1st October X4. So additional 6 months means 0.5 years. So the remaining life is 20 minus 6.5 is 13.5 years. So the remaining life of this property is 13.5. Revalued amount will be depreciated over its remaining life, which is 13.5. And we will depreciate only 6 months. So 10,800 divided by 13.5 into 6 upon 12. I'm getting 400. So the depreciation will be 700. So I hope it is clear to everyone. So the total appreciation is 7 lakh because 3 zeros are already there. So basically, examiner has not asked us what is the amount of the revaluation surplus. He did not ask us how much revaluation surplus should be realized. Nothing is mentioned. Nothing. These are not the requirement in this question. Examiner has asked us only one thing. What is the total appreciation for this year ended March X5, which we have calculated. The main concept is after evaluation, if examiner is not giving you the remaining useful life, then you have to calculate the remaining useful life. After evaluation, asset will be depreciated over its remaining useful life. Another point is we have discussed previously as well that after revaluation, obviously when organization recognizes the revaluation surplus, then after revaluation, when we depreciate the asset, then revaluation surplus will be realized. But realizing the revaluation is going to be your accounting policy. It is not mandatory that you have to realize. No, it is just an accounting policy. It is up to the company either they realize or not. Let's move to another question. Which two of the following statements about IAS 20 government grant, accounting for government grants and disclosure of government assistance are true? Which two? So out of four, either you should be able to identify which two are correct. If you cannot, then at least try to identify which two are incorrect. Let's see. Which two of the following statement about IAS 20 for government grant and disclosure are correct? Number one, a government grant related to the purchase of an asset must be deducted from a carrying amount of the asset in the statement of financial position. So we are having an objection. The objection is why you are saying must be deducted. If you recall, there are two types of government grants in IAS 20. One is capital nature grant, which relates to the asset. So the grant which relates to the asset, that's a capital nature grant. There are two treatments. One, you can deduct the grant from the carrying amount of the asset. Another, you can treat the government grant as deferred income. Then slowly and gradually that deferred income will be amortized over the useful life of the asset. So basically here the objection is the way they have written, they are saying actually this is the only choice with you, that whatever government grant you are getting, you must deduct from that carrying amount of that asset. So basically, it is not the only accounting treatment. There's another accounting treatment available also. You can treat the government grant, capital nature grant as deferred income. So that is why statement A is incorrect. A government grant related to the purchase of an asset should be recognized in P&L over the life of asset. That is true. It is possible. A government grant related to the purchase of an asset should be. They're not saying this is the only treatment. No, it should be. So basically, it is very much possible that the government grant which you are getting, you are treating that government grant, let's say, as deferred income and recognizing that as income over the useful life of the asset. So a government grant related to the purchase of an asset should be recognized in P&L. Okay. So B is true. Free marketing advice provided by the government department is excluding from the definition of the grants true. Actually, when we say government grant, so government grant is a physically you can say the resources will be transferred from government to the your company. So when there's a free marketing advice, it is actually not the free marketing advice only for your company, it is for everyone. So free marketing advice provided by the government department is excluded from the definition of the government grant because it is available to everyone. It is not the government grant for you. So B and C are true. Let's see what D says. Any required repayment of government grant received in an earlier reporting period is treated as a prior period adjustment. That's false. Actually, when we repay the grant, any required repayment of government grant received in an earlier reporting period is treated as actually current period adjustment, not the prior period. Current period adjustment. For example, if let's say in 2024, a portion of government grant you have received as an income. Now in 2025, we are repaying the grant. So the grant which you have recognized as an income previously, it will be recognized in 2025 as an expense, as current period adjustment, and that will be reflected in 2025 profit and loss. Prior period adjustment means that I'm supposed to adjust against the opening retained earning. So we do not treat repayment of previous year government grant, earlier period government grant as prior period adjustment. We treat it as current period adjustment, and impact comes in the current year P&L. That is why point number D, statement number D is incorrect. So the true statements are B and C. Okay, what are they asking here? What is the total net amount to be recorded in the statement of P&L in respect of the office for the year ended December X5? What is the total net amount to be recorded in the statement of P&L, profit and loss, in respect of the office for the year ended 31st December X5? Okay, let's see. Total amount. Smithson Company purchased a new building with a 50-year life for $10 million. Great. They bought a building. The life is 50 years for $10 million. On January X3, on 30th June X5, Smithson's company moved out the building and rented it out to a third party on a short term lease. Okay. Smithson Company purchased a new building with a 50-year life on January X5. Smithson moved out to the building and rented it out to a third party on a short lease. Smithson Company uses the fair value model for investment property. At 30th June X5, the fair value of the property was 11 million. And December X5, it is 11.5 million. And we have been asked the net impact in this on the net effect that will be recognized in the statement of P&L. Now, please listen carefully. What is happening? Number one, there is a transfer as well. Earlier, we were using this building in the business. So it means earlier we were applying IAS 16 on that building, and now it has transferred from IAS 16 to IAS 40. Okay, no issue at all. Under IAS 40 investment property, there we are following investment property fair value model. So IAS 40 investment property says when a investment property is carried at fair value model, then no depreciation. And whatever the change comes in the fair value, that will be recognized in P&L. Okay. Number one, simply when we have shifted the property, transfer the property from IAS 16 to IAS 40. Let's see, it happened on 30th June X5. So it means that first, in the first 6 months, we will be depreciating this property over its original useful life, which is 50 years. Just keep watching. Depreciation expense. First 6 months, that is from 1st January X5 till 30th June X5. 10 million. The useful life is 50 years. When we'll be dividing this with 50, so we'll get annual depreciation, but we need only 6 months. So 10 million divided by 50, I'm getting 200,000, 6 by 12. First 6 months in the current year. Depreciation expense is 1 lakh. First 6 months, depreciation expense is 1 lakh. Okay. Another point. When we are transferring a property from IAS 16 to IAS 40 investment property fair value model. So before transferring the property from IAS 16 to IAS 40, we have to first bring our property plan and equipment at revalued amount, which is 11. And whatever is the difference between carrying amount and revalued amount, difference is the revaluation surplus, and revaluation surplus actually goes to OCI. An examiner is not asking us that what you have recognized in OCI, what is the revaluation surplus. Examiner is asking us the net impact in the income statement. So basically, December X5, in the first 6 months, the depreciation is 1 lakh. And when the property was transferred on 30th June X5, revalued amount, or you can say the fair value, was 11 million. Now, after reaching at 11 million, now from here onwards, whatever the value in changes, that impact goes to P&L and no more depreciation. Once you have transferred the property from IAS 16 to IAS 40, under IAS 40 fair value model, no depreciation. Now the property is coming from, the fair value of the property has come from 11 million to 11.5. It means after the transfer from IAS 16 to IAS 40, there is a fair value change, and that is 0.5 million, means 5 lakh. That goes to P&L. It means fair value gain on investment property is 5 lakh. Depreciation is 1 lakh, fair value gain is 5 lakh. So net income, net gain is 4 lakh. Net income, net gain is 4 lakh. Let's see. Net income is 400,000. Now let me repeat. Here what is happening? There's a transfer from IAS 16 to IAS 40 fair value model. Obviously, before the transfer, for first 6 months, we have depreciated the property. And the carrying amount of the property and the revalued amount, which is 11 million, difference goes to revaluation surplus OCI. Then the difference between 11 million and 11.5, that is actually a change in the fair value. And under IAS 40, change in the fair value is recognized in income statement in the P&L. So basically, if I just give you a little bit more calculation, the building was purchased on January X3. And it is transferred from IAS 16 to IAS 40 on 30th June X5. If I just show you the complete accounting, property, bought it for $10 million. Logically, it was depreciated the entire X3, entire X4, and during X5, how many months? 6 months. It means accumulated depreciation 10 million divided by 50, into 2.5. I'm just showing you the entire accounting, the total accounting. Accumulated depreciation is 5 lakh. 9.5 million. Now, logically, this 9.5 million will be compared with 11 million. So difference of these two value will be treated as revaluation surplus according to IAS 16, and that goes to OCI. A very important point is either company is using following cost model or revaluation model. No issue at all. When there's a transfer from IAS 16 property, plant and equipment from, let's say, cost model to the fair value model of IAS 40 investment property. Number one, if you ask me the proper accounting is before actually transferring the property, plant and equipment from IAS 16 to 40. First calculate the net book value, then compare that net book value with the, you can say, fair value or revalued amount. Difference is your revaluation surplus according to IAS 16. So after this 11 million, whatever the change comes in the fair value, that change is treated as gain or loss in the fair value of investment property. And under IAS 40 investment property, whatever the change comes in the fair value under fair value model, that is recognized in P&L. And after, obviously, under IAS, you can say under IAS 40 fair value model, no depreciation. So 11 million and 11.5 million. The difference of 5 lakh, this is under IAS 40. And that goes to P&L. This is under IAS 16 and that goes to OCI. I hope it should be more now clear to everyone. Okay. Let's see the next question. What are they asking? What are the total borrowing costs to be capitalized in respect of the warehouse? IAS 23. Can I say under IAS 23, there are two types of borrowing. One is specific borrowing and another is general borrowing. Under general borrowing, we know that we need to calculate rate of capitalization. Once you have calculated the rate of capitalization, then expenditure incurred multiplied by rate of capitalization, you will get borrowing cost to be capitalized. From the total borrowing cost, if you deduct the borrowing cost to be capitalized, you will get borrowing cost expense out. But in case of specific borrowing, under specific borrowing, how do we calculate borrowing cost to be capitalized? Basically, when you have started the expenditure on qualifying asset, on the preparation of development of construction of qualifying asset, from that period onwards, whatever borrowing cost you are bearing, that borrowing cost will be capitalized minus the return which you have earned on short-term investment. For example, your organization has taken a loan for a qualifying asset, and that is a specific borrowing. Let's say, for example, one loan for one qualifying asset. So under a specific borrowing, the time period of borrowing cost to be capitalized, whatever the borrowing cost you have calculated minus the return which you have generated from by depositing the fund for a short period of time. Let's see. Gilbert took out 7.5 million, 10% loan on January 6. How much loan? 7.5 million to build a new warehouse during the year. Okay. Construction of the warehouse began on 1st Feb X6. was completed on 30th November X6. Very important point. The loan was taken on January X6, but work started on 1st Feb X6. So we will start borrowing cost capitalization from 1st Feb X6 onwards. Because in the first month, that is in January, this company had that 7.5 million, but they did not utilize it for a qualifying asset. So borrowing costs will be capitalized. We will start capitalizing the borrowing costs, let's say from 1st Feb X6 till 30th November X6. The time period, if you count it, is 10 months. So logically, 10 months borrowing costs will be capitalized. Very important point is January borrowing costs will not be capitalized, and December borrowing costs will not be capitalized, because once the qualifying asset is completed, let's say you have to still pay the interest on that loan, but the main point is if the qualifying asset it has been completed, after that no more capitalization of the borrowing cost. So basically the borrowing cost of January you cannot capitalize. Why we cannot? Even though we are paying it, we have paid the borrowing cost in the January. Why can't we capitalize? Because you did not started the work. So logically, when you have started spending the loan on the construction of a qualifying asset, from that on point onwards, you will start capitalizing the borrowing cost. Okay. As not all the funds were needed immediately, Gilbert invested 2 million in 4.5% bonds from 1st January to 1st May X6. Now, very important. The borrowing cost which we are capitalizing, the time period of, if I just show you the timings, since 1st Feb X6 till 30th November X6. These are the 10 months. The borrowing cost which this company has basically paid, only out of that borrowing cost paid, only 10 months borrowing cost will be capitalized, and the 10 months they are starting since 1st Feb X6 and they end on 30th November X6. Now listen carefully. The borrowing costs of these 10 months will be capitalized, and during these 10 months, only during these 10 months, if any funds out of that loan was invested for a short period of time, then return will be deducted from the borrowing cost. But important concept is, if I'm capitalizing the borrowing cost of 10 months and the 10 months are starting since 1st Feb X6, they are ending on 30th November X6, then within only these 10 months, if organization has invested any amount out of that loan, so whatever return they have generated during these 10 months, either 1 month, 2 months, but months should be within these 10, then return which company has earned by investing short-term investment, that return will be deducted from the borrowing cost. Now look at this. Examiner is saying they have invested 2 million at 4.5%. The time period is they have invested. If you look at this, investment period is 4 months. From 1st January till 1st May. If you count the time months, they are 4 months. But we cannot deduct the 4 months return from the borrowing cost to be capitalized of 10 months. Only 3 months return on short-term investment will be deducted. Why 3 months? Because the return organization has taken that return in January, but since in January the work of was not started, since as 1st January, as the month of January, we are not considering for calculating the borrowing cost to be capitalized. So that is why whatever return company is generated in January, that is right now, we will also not consider it. So simply the return actually which we'll be taking, that will be the month of Feb, March, and April. So how will we calculate borrowing cost to be capitalized? The amount of the loan is 7.5 million. %, and borrowing cost capitalized will be of 10 months. Let me use the calculator. 7.5 million. I'm getting 6,25,000. From this 6,25,000, we will deduct the return on short-term investment, but only 3 months. Even though they have invested the fund for 4 months, but only the relevant months for calculating borrowing cost to be capitalized, they are 3 months. How much they have invested? 2 million at 4.5%. So 2 million, 4.5%, and 3 months. That is Feb, March, and April. 22,000. The return is 22,500. So from 6,25,000, we'll deduct 22,500. So basically, the borrowing cost to be capitalized is 6,02,500. So the borrowing cost capitalized is 6,25,000. Okay, now come here. If Croft Company uses the fair value model for investment property, so we know that under IAS 40 investment property fair value model, number one, there's no depreciation. Number two, whatever the change comes in the fair value, that change is directly recognized as gain or loss in the statement of profit or loss. So if Croft Company uses fair value model for investment properties, what gains should be recorded in the statement of profit and loss for the year ended December X3? Let's see. Croft acquired a building with a 40-year life for its investment potential for 8 million. Croft acquired a building with a 40-year life for its investment potential. So IAS 40 for 8 million. On January X3, December X3, the fair value of the property was estimated 9 million. With cost to sell is 2 lakh. Okay. If Croft uses the fair value model for investment property, what is the gain should be recorded? Now listen, initially the investment property was having a value of 8 million, fair value 8 million. When Croft acquired this, bought this investment property, at the year end, the fair value is 9 million. So basically, 1 million change is recognized. The gain of 1 million is recognized in the P&L. Important concept is under IAS 40, investment property will keep the investment property at fair value, and the changes in the fair value they will go to P&L. Only the fair value means this 200,000 cost to sell is irrelevant. So 8 million will only be compared with the fair value, and the fair value is 9 million. So main concept is under IAS 40, this cost to sell is irrelevant. Only the fair value will be compared with the fair value. So basically, 3 zeros are already there. So 1 million means I'm just writing 1,000. So basically, 1 million gain will be recognized in P&L. Now come here. Which of the following cannot be recognized as an intangible asset? Normally, when you read the term intangible asset, IAS 38 should come in your mind. Okay. Which of the following cannot be recognized as an intangible non-current asset in GHK's consolidated statement of financial position at 30th September X1? The year end is 30th September X1. Let's read the question again, requirement again, in fact. Which of the following cannot be recognized as an intangible asset? Okay, let's read. GHK spent 1,32,000 developing a new type of product. Great. In June X1, management worried that it would be too expensive to fund. The finances to complete the project came from a cash injection from a benefactor received in November X1. Now listen and listen carefully. Question says which of the following cannot be recognized as an intangible non-current asset in GH case consolidated statement of financial position at 30th September X1. Can I say the fund is coming after the year end? If you recall under IAS 38, when we capitalize the expenditure, so in that there are a number of conditions. One of them is completion of your intangible asset is financially feasible. Can I say they have basically arranged the finance, but the arrangement of the finance was made after the year end. And we have been asked that tell us out of these four statements, which one cannot be recognized intangible asset at 30th September X1. So obviously A cannot be recognized as an intangible asset because 30th September X1 fund was not available. Now let's read other as well. GHQ purchase a subsidiary during there. So we're acquiring a subsidy during there. During the fair value exercise, number one, let me just give you an overview. When parent acquires the subsidy, then it is the requirement of IFRS 3 that at acquisition you have to bring all the net assets of subsidy at fair value at acquisition. And the difference between the carrying amount of net asset at acquisition in the individual books of subsidy and their fair value, the difference is the fair value adjustment. But this fair value adjustment exercise is only carried out at acquisition. Now, it is very much possible that your XY, the subsidy which you have acquired, it has a brand, but let's say they have not recognized that brand because according to IAS 38, you can internally generated brand cannot be recognized. Okay. Because if you're recognizing internally generated brand means they are like internally generated goodwill and it is strictly prohibited in IAS 38. You cannot recognize internally generated goodwill. Fine. But listen carefully. When parent is acquiring a subsidy, and experts of parent, they are assigning a value to your brand in that case, and the fair value of that brand is determinable by the parent experts at acquisition, then in that case, we will recognize that brand and will take it as a fair value adjustment in group accounts. GHK purchased a subsidy during the fair value exercise. It was found that subsidy had a brand name with an estimated value $50,000, but had not been recognized by the subsidy as it was internally generated. So we will recognize. So in group accounts, it will be recognized, and it will be a fair value adjustment at acquisition. GHK purchase a brand. Now listen, there are two types of intangible assets. One is purchase intangible asset, another is internally generated intangible asset. Obviously, intangible asset will only be recognized when the recognition criteria is met. But in case of purchase intangible asset, we normally, you can say, assume that recognition criteria is met. So GHK purchase a brand name from a competitor on 1st November X2. So obviously it will be recognized as an intangible asset. GHK spent $21,000 during there on development of a new product. After management concluded it would be viable in November X0. The product is being launched and they have launched the product and is expected to be profitable. So GHQ spent 21,000 during there on development of a new product but they spent 21,000. When did they spend? After management concluded it would be viable in November X0. So obviously when you are spending $21,000 after the management, they have concluded it will be viable to spend money on this development of the new product. So definitely it will be capitalized. So only A's cannot be capitalized because in A what happened? The fund they came after the year end. Let's see. Which of the following could be classified as development expenditure? In M statement of financial position as at 31st March Y0 according to IAS 38 intangible asset. Okay, let's read again question. Which of the following could be classified as development expenditure? Basically in IAS 38 there is very famous example. The name of the example is research and development expenditure. Actually development phase means when we are working on the findings of the research. Development phase means the research phase is over and now you have started the development. And under development phase, we know that there are 6 conditions. When all of the 6 conditions are met, then you will start capitalizing the development expenditure. If just quickly we recall that 6 condition, number one, completion of that intangible asset is financially feasible, number one. Technically feasible, number two. Company is having the intention either to use it or to sell that asset. Fourth, company is having the ability to use or sell that asset. Fifth, company can demonstrate how they will be getting the economic benefit from that asset. Either you will be getting the economic benefit by selling that asset or by utilizing that asset. Last, organization can measure reliably the remaining expenditure on the completion of the intangible asset. When all these 6 conditions are met, only then we start capitalizing the development expenditure. Okay. Which of the following could be classified as development expenditure? Let's read. And one more thing. Research means whatever amount you are spending in order to acquire the new knowledge. That is the research. 1,20,000 is spent on developing a prototype and testing a new type of propulsion system. The project needs further work. It has the system is currently not. Can I say this cannot be capitalized? Because it is quite clear. Look at this. The project needs a further work on it as the system is currently not viable. Can I say all the criteria of IAS 38 for development expenditure to be capitalized, they are not met? Because it says the project needs further work. Okay. It as the system currently is not viable. A payment of $50,000 to a local university engineering faculty to research the new environmental friendly building techniques. Can I say in research phase, if you're spending, obviously when you're spending money on the research, it cannot be capitalized. It is categorically written in IAS 38 that the amount which you are spending in research phase on that research, so obviously it will be expense out. Okay. $35,000 developing an electric bicycle. How much? $35,000 developing an electric bicycle. This is near completion and product will be launched soon. As this project is first of its kind, it is expected to what? Make a loss. Actually, the C cannot be capitalized. The question is why C cannot be capitalized? Because it is not meeting all the criteria. What do you mean by this? If you recall, we said completion of the internally generated intangible assets should be technically, financially feasible. Companies having the intention to utilize or sell the asset, they're having the ability to utilize or sell the asset. Another point was that how will company is going to get the economic benefit from that asset? Company is in a position to demonstrate how they will be getting the economic benefit. So here they're not talking about economic benefit, they're saying something else, that they are thinking will be having a loss. So as this project is first of its kind, it is expected to make a loss. So we are saying no. All the criteria is not met, because IAS 38 says you should be able to demonstrate how will you get the economic benefits, rather than you tell us that you are going to have a loss. So we are left with only one choice. 65,000, developing a special type of new packaging for a new energy efficient light bulb. The packaging is expected to reduce distribution cost by. So if you look at this, D will be capitalized. $65,000, developing a special type of new packaging for a new energy efficient light bulb, and packaging is expected to, they're also telling us how you will get the economic benefit. So question number 17, D will be capitalized. Which two of the following factors are reasons why key staff cannot be capitalized as an intangible asset by an entity? So I simply, we cannot capitalize the key staff. Okay, so you can say the skill of key staff we cannot capitalize. Which two of the following factors are reasons why key staff cannot be capitalized? They do not provide expected future economic benefit. No, they do provide economic benefits. They cannot be controlled by this is true. You cannot control. You might be thinking, sir, what about an employment contract? Even there is an employment contract, if your employee leaves, you cannot do anything. You can maximum ask for the damages, nothing else. Even the judge cannot help you, because the law says we cannot get you the specific services. So simply you can get the damages due to the employment contract, but you cannot control that particular person. They cannot be controlled by an entity. So B is true. Their value cannot be, yes, their value cannot be measured reliably. You cannot measure the value reliably. How can you measure? Because if we start measuring the value reliably, then two people having the same qualification, having the same experience, they should be earning the same amount. But I would say 99.99% it is not the case. Both of them will be earning the different amount. So simply, we cannot measure their value reliably. They are not separable from the, they are separable. So basically, B and C. Two of the following factors, we have said the B and C are the factor. That is why, due to B and C, we are not capitalizing the key stuff. Obviously, they are separable from the business. If you are running a business, in your business, there's Mr. Y. So you know that who is Mr. Y, yes or no? What is your business and who is Mr. Y? You know that, yes or no? Is this clear? So this is obviously Mr. Y is separable from your business. What is the carrying amount of development expenditure asset as at 30th June X5? What is the carrying amount of the development expenditure asset? Yeah, separately identifiable. Yes, separable means yes. So obviously, Mr. Y is separately identifiable and is a separate legal entity, separate legal individual, and your business is separate. Got it? Okay. What is, I hope it is clear now. Great. What is the carrying amount of the development expenditure asset as at 30th June X5? So we need to calculate simply carrying amount of development expenditure. Let's see. AMCO carries out research and development R&D in the year ended 30th June X5. AMCO company incurred total cost in relation to project X 7,50,000. So the total cost which company has incurred, that is 7,50,000. spending the same amount each month up to 30th April X5. Okay. When the project was completed, the product produced by the project went on sale from 31st May X5. Okay. The project had been confirmed as feasible on January X5, and the product produced by the project was expected to have a useful life of 5 years. Great. Now, what they are asking us what is the carrying amount of the development expenditure asset on 30th June X5. Number one, the project had been confirmed as feasible January X5. Number one point is the main concept is we will start capitalizing this development expenditure, but from January X5 till 30th April X5. It means 4 months development expenditure will be capitalized. Only 4 months development expenditure will be capitalized. Now read again. M company carries out R&D. In the year ended is 30th June X5. This is year ended. Okay. Total expenditure they have incurred is 7,50,000. Fine. Spending the same amount means same amount each month. Up till what? 30th April X5. Now listen carefully. The year end is 30th June X5. And they were spending same amount every year till 30th April X5. It means on 30th April X5, the XYZ intangible asset was completed 2 months before the end of the year. It means that logically total 7,50,000 was spent over 10 months. Every month they were spending 75,000. Every month they were spending 75,000. Only 4 months development expenditure will be capitalized because the question says the project had been confirmed as feasible on 1st January X5. So from 1st January X5 till 30th April X5. 1st January X5 till 30th April X5. 4 months development expenditure will be capitalized. That is 75,000 multiplied by 4. So the capitalized amount is 3 lakh. Now, another very important concept is they have given us a useful life 5 years. Fine. But please read the question. Project was completed on 30th April X5. The product produced by the project went on the sale on 31st May X5. So the day the product went on sale, from that date onwards, you will start amortizing this intangible asset. Even though intangible asset was completed on 30th April X5, but the product produced by the project went on sale on from 31st May X5. So IAS 38 says when an intangible XYZ asset was completed, and let's say the product from that intangible asset goes on sale after 1 month, 2 months. So that is the time period from that time period onwards, you will start amortizing it. So logically, we will amortize this intangible asset only 1 month. So simply 31st May X5 is the date from here onwards the product started going on sale. So we will deduct the amortization as well. 300,000. Life is 5 year. 1 upon 12. Just a minute. 300,000 divided by 5. I'm getting 60,000. Multiply by 1 upon 12. It is 5,000. So logically, the carrying amount is 2,95,000. The carrying amount is 2,95,000. Okay. Which of these describes how SABIL should treat these intangible assets of Basel in their consolidated financial statements? Let's read. Which of these describes how Sable should treat these intangible assets of Basel? I think we have discussed earlier as well. When parent is acquiring a subsidy, so at acquisition, you have to bring all the net assets carrying amount of subsidy at fair value at acquisition. And difference between fair value and carrying amount of subsidies net asset is the fair value adjustment. Say Bill has acquired a subsidy Basel in the current year. Basel has a brand which has been reliably valued by Sable, which is parent, 5 lakh. And a customer list of which Sable has been, what did they say? There's a customer list as well, but listen, there's a customer list which is also an intangible asset, but the problem is we are parents, professional, they are saying we are unable to find the value of the customer list. Obviously, if you are unable to find out the value of the customer list, so you cannot do anything. Simply the fair value adjustment is only one, that is a brand. And if there is a customer list, obviously, which will have a good impact for you, but technically, logically, the impact of that customer list will be built in into the goodwill which you are going to calculate. Separately, we cannot recognize customer list as an intangible asset. Why? Because question says parent is unable to value this customer list. When you are unable to value the customer list, so how can we assign any value to that? Let's see what are the choices. They both should be included in goodwill. No, 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 no. They will both will not be a part of goodwill because brand is the fair value of the brand is reliably measurable. The brand should be capitalized as a separate intangible asset, whereas the customer list should be yes. Brand you will be recognizing it as a separate as intangible asset, and the customer list will be included in the goodwill. Both brand and customer list should be capitalized as separate. How can you do that? You don't know the value of the customer list. The customer list should be capitalized separate. Oh, you cannot do that. There's no value. You're unable to assign any value to that. Okay, now. What are they asking? What amount will Dempsey charge to profit or loss for development cost, including any amortization for the year ended? We know that under IAS 38, in case of R&D, so in obviously when you are in research phase, you have to expense out your expenditure. Even in development phase, until unless all the 6 conditions are not met, whatever expenditure you are spending in development phase, you have to expense out. Development expenditure will you will only start capitalizing them when all the 6 conditions are met. Number one, completion of intangible asset, internally generated intangible asset. Completion is technically feasible, number one. Financially feasible, number two. Third, company is having the intention to use or sell the asset. Fourth, company is having the ability to use or sell the asset. Fifth, company is in a position to demonstrate how they will get the economic benefit from that asset, either by using that asset or by selling that asset. And the last, company can reliably measure the remaining expenditure on the completion of intangible asset. When all these 6 conditions are met, only then we start capitalizing the development expenditure. Here they're asking us how much will you take to the P&L, that is how much you have expense out, and even tell us the amortization as well. Let's see. Dempsey company owns a pharmaceutical business with a year end 30th September X4. Okay. Dempsey company commenced the development stage of a new drug on 1st January X4. $40,000 per month was incurred until the project was completed on 30th June X4. They started from 1st January X4 and they went till 30th June X4. Per month they were spending 40,000. When the drug went into immediate production, okay, the director became confident of the project's success on 1st March X4. It means before 1st March X4, they were not confident. It means we will start capitalizing these expenditure from 1st March X4 till 30th June X4. So 4 months expenditure out of 6 will be capitalized. And first 2 months expenditure will be expense out. Because in the month of Jan and Feb, it means you were not confident. So first 2 months expenditure will be expense out. The drug has an estimated useful life 5 years and time apportion. Okay. So we will amortize this as well. And amortization will be for 3 months. Why 3 months? Because it was completed on 30th June X4. And what examiner says, when the drug went into immediate production, on a very next day, the production was started. On a very next day. So since on a very next day, the production was started, so we will start amortization from 30th June, you can say from 1st July X4 till 30th September X4, 3 months amortization will be there as well. So it means first 2 months expenditure, that is, they were spending how much? 40,000. So Jan and Feb. 40,000 multiplied by 2. Your capitalized amount is 40,000 into 4, that is 1,60,000. We will amortize this 160 for 3 months. 1,60,000. Useful life is 5 years. 3 months amortization. Let me use the calculator. 1,60,000 divided by 5, 3 by 12. 8,000. So the amount which will be charged to P&L, that is 88. The amount which will be charged to P&L, that is 88. Okay, now let's go ahead. What? Okay. Which of the following statement relating to intangible asset is are true? All intangible asset must be carried at amortized cost. At an impaired amount, they cannot be revalued upward. Can I say false? If you recall IAS 38, IAS 38 actually gives us two models. One is cost model, another is revaluation model. Of course, with the revaluation model, condition is attached. The condition says you can only go for revaluation model when there is an active market, but the revaluation model is still there. So statement number 1 is false. The development of a new process which is not expected to increase sales revenue may still be recognized as an intangible asset. True. If you just recall the conditions when we start capitalizing the development expenditure, one of them out of 6, the one condition is organization is in a position to demonstrate how they will get the economic benefit from that asset, either by selling it or using it. So it is not necessary all the time we'll be selling the asset. There's a possibility by utilizing the asset, we are saving the cost. So that is also an economic benefit. So it is not necessary that all the time revenue will increase. There's a possibility that we are generating an intangible asset, and by using that internally generated intangible asset, we will be saving the cost. So that is also an economic benefit for your company. So that is why statement number 2 is true. Okay, let's come here. To the nearest 1,000. What is the balance on the building following an impairment review? Okay. What is the nearest 1,000? Now let me just IAS 36. Impairment of asset. The objective of IAS 36 is the carrying amount of asset should not exceed the recoverable amount. According to IAS 36, impairment of asset, the objective of IAS 36 is carrying amount of the asset should not exceed the recoverable amount. Okay, recoverable amount is higher of. Recoverable amount is higher of fair value minus cost to sell. And the second is value in use. If asset is having a carrying amount more than the recoverable amount, then difference is the impairment loss. If carrying amount is more, recoverable amount is less, difference is your impairment loss. Now let's see. What they are asking? To the nearest thousand, what is the balance on the building following the impairment review? A division of an entity has the following balances in its financial statement: goodwill, patent, building. Building is having a carrying amount 2.3 million. Intangible asset 8 lakh. Other net asset 430. Following a period of losses, the recoverable amount of the division is deemed to be 4 million. A recent valuation of the building showed that building has a market value how much? The market value of the building is 2.5 million. The other net asset at their recoverable amount. The entity uses the cost model for valuing the building and plant. Now listen and listen carefully. The building is having a carrying amount of 2.3 million. And the same building is having a market value 2.5 million. Now listen carefully. If the carrying amount is 2.3 million, if the carrying amount is 2.3 million and the market value is 2.5 million. So number one is when you will start assigning the impairment loss under cash generating unit, we know that under cash generating unit means the smallest identifiable group of assets which cash inflows are largely independent from other cash generating units. Basically, one asset and a single asset will not generate the cash flows. Normally, it is the group of assets which generate cash inflows for your company. Let's, for example, if I just give you an example, let's say the every branch of Pizza Hut, every branch of Pizza Hut is a separate cash generating unit because cash inflows of one Pizza Hut branch, they do not depend on other Pizza Hut branch. So each branch of KFC, McDonald's, Pizza Hut, they are separate cash generating units. Okay. Now, under cash generating unit, how do we allocate impairment loss? First, if there is any specifically mentioned asset means if examiner says, let's say, XYZ asset is destroyed due to fire, something like that, that a fixed asset, plant and machinery is destroyed, for example. So that's a specifically mentioned asset. If there is no such information, then number one is goodwill, and number two, all other assets on pro rata basis which fall in the scope of IAS 36. Okay, now listen carefully. But when you start allocating the impairment loss, make sure you cannot bring down the value of asset lower than the recoverable amount. For example, if the recoverable amount is 1 million and the carrying amount is 1.2, so the maximum impairment loss which you can book is 2 lakh. You can bring carrying amount 1.2 million to 1 million, but you cannot reduce the 1.2 million below 1 million. So, according to IAS 36, maximum you can bring the carrying amount of the asset to its recoverable amount, but it cannot go below the recoverable amount. Now, listen, what is happening over here? Building is having a carrying amount. Actually, when do we recognize impairment loss? When carrying amount is more, recoverable amount is less, then there is an impairment loss. Now, in case of building, what is happening? The carrying amount is 2.3 million. And let me tell you, if the carrying amount is less and the recoverable amount is more, then there is no impairment loss. And this is happening in case of building. The carrying amount of the building is 2.3, which is less. The recoverable amount is 2.5, which is more. So actually, there's no impairment loss in building. So building will remain at 2.3. You cannot bring 2.3 to become 2.5. No, 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 no. If the recoverable amount is more than the carrying amount, if the recoverable amount is more than the carrying amount, then your asset will remain at its carrying amount. It will not come to the recoverable amount. Only when carrying amount is more and the recoverable amount is less, in that case, you will reduce the carrying amount. So here the building will actually remain at 2.3 million. So it's not going anywhere. Building is not actually going anywhere. Okay. To the nearest thousand, what is the balance on the plant following the impairment review? A division of entity is the following balances in its financial statement. We have goodwill, plant, building, intangible asset, other net asset. Let me tell you. Other net assets. They're not falling in the scope of IAS 36. Why? Because examiner is not mentioning exactly. Because if you ask me, so under IAS 36, I cannot allocate any impairment loss to debtors to stock. I can't do that. They do not fall in the scope of IAS 36. Under IAS 36, in a cash generating units, normally we will allocate the impairment loss first to the goodwill, then to the remaining assets, they fall in the scope of IAS 36. Okay. Following a period of loss, the recoverable amount of the division is deemed to be 4 million. So the recoverable amount is 4 million. A recent valuation of the building showed that building has a market value how much? 2.5 million. So building is having a value 2.5 million. So simply I cannot allocate any impairment loss to the building as well, because the fair value of the building is far more than the carrying amount of the building. The other net asset at their recoverable, other net asset, they are already at their recoverable amount. No need to do anything. The entity uses cost model for valuing a building and plant. Now listen carefully. Let me just use the calculator. Let us first calculate what is the total amount of what is the total of this cash generating unit? 7 lakh plus 9 lakh 50,000 plus 2.3 million plus 8 lakh plus 4 lakh 30,000. Students, I'm getting 5.18 million. 5180 triple 5.18 million. Okay. And the recoverable amount is 4 million. Look at this. Logically, the impairment loss 4 million, which is the recoverable amount, and the carrying amount is 518000. Let's see. So the total impairment loss which I have to allocate to this cash generating unit is 1.18 million. How will we allocate this 1.18 million? Number one, we will allocate this to goodwill. Remaining impairment loss will be allocated to on pro rata basis to the plant and intangible asset. We cannot allocate any impairment loss to other net asset. Number one, examiner is categorically written that other net asset, they are at their recoverable amount. So no need to do anything. I cannot allocate any impairment loss to the building because building's recoverable amount is even more than the carrying amount, which is 2.3. So we are left with only two assets. One is plant, another is intangible asset. Only these are the two assets. To them, we will allocate the remaining impairment loss on pro rata basis, which means that out of 1180, 7 lakh is allocated to the goodwill. So how much is left? 7 lakh is allocated to the goodwill. So still we are left with 4 lakh 80,000. Basically, remaining loss 4 lakh 80,000 will be allocated to plant and intangibles on their on the basis of their carrying amount. Look at this. Remaining loss is 4 lakh 80 divided by 9 lakh 50,000 is the value of the plant. Intangibles 8 lakh. So 9 lakh 50 plus 8 lakh. The total is 17 lakh 50,000. Multiply by the value of the plant, and the value of the plant is 950. So let's see how much we can allocate to the plant, and this is what we need to calculate. I'm getting 2.6 to the nearest thousands. The answer which I'm getting is 260,571. 260,571, or you make it 261 to the nearest thousand. It means plant. From this 9 lakh 50,000, if I deduct 261, 950 minus 261, I'm getting 6 lakh 89,000. So to the nearest thousand, what is the balance of the plant? The impairment of following the impairment review means after the impairment review, that is 6 lakh 89. So just I'm writing 689 because 3 zeros are already there. Okay, now what they are asking, what is the recoverable amount of the vehicle following the accident? Actually, recoverable amount is higher of fair value minus cost to sell and value in use. A vehicle was involved in an accident exactly halfway through the year. The vehicle cost is 10,000, had a remaining life 10 years. At the start of the year, following the accident, the expected present value of the cash flow associated is 3,400. Fair value minus cost to sell. So can I say? The recoverable amount is 6,500. Why? Because recoverable amount is higher of fair value minus cost to sell and value in use. So simply 6,500. Okay, students, I'm just giving you a very small homework to every one of you. Please try to attempt at least these 3 questions. And I think all of them, I think they belong to IAS 36. So inshallah, you, after, of course, today's class, now you are in a better position to attempt these questions. Inshallah, in the next class, if you have any issues, of course, you can ask in your respective WhatsApp group. I will respond, no issue at all. In the next class, obviously, we'll be revising other areas as well. And you people might have noticed that today's live revision class was longer than the previous 2 live revision classes. And slowly and gradually, the time period of the live revision class will increase. The day will remain once in a week, but the time period will increase. So thank you very much. And one more thing, is there any IAS, is there any topic which you people want specifically to be revised? So do mention in your WhatsApp groups so we can, you know, take, we can keep the classes on that topic as well. So thank you very much for today's class. See you all inshallah in the next class.